Okay, folks, this is probably how you feel if you're following the herd mentality around the stock market right now. And I want to clarify some of the confusion coming out of CNBC and especially Jim Cramer's mouth, because people are telling you to take profits on tech. People are telling you to buy this dip, but what do you do? Well, we're going to clarify some of the valuation metrics on a bunch of different companies that sit in the tech sector to try and verify if there is an actual bubble going on here, folks. And so just taking a look at the S&P 500 when it comes to herd mentality, and I'm sure you were recognizing this yourself, maybe even your friends were coming up to you if you're the big investor in your family or your friend group, and they were probably saying, well, the markets just keep going up. They just keep going up. Is this my time to buy in? I mean, I had friends coming up to me as late as last week that have never been in the markets before that are like, well, they're just going to keep going up, aren't they? Because that is what you get used to when the market follows a trend for such a long period of time that will eventually lead us into a trap here in which the markets over the last 5 days have sold off a pretty healthy chunk. I mean, we're only talking about 4.5% on the S&P 500, but on the individual stock basis, which is what we're going to take a look at, is a completely different story here, folks. And it looks like the volatility is returning to the market. As if we take a look at the volatility index back in March, this chart follows the exact opposite of what the S&P does, by the way, because back in March, we can see the volatility index hit record highs it hasn't seen in a while, because the only time this chart specifically moves is if there's just a lot of people trading in and out of stocks and using options here, folks. But in the clarity of my transparency, we're going to take a quick listen to the Jim Cramer, and then I'm going to break down some of these individual stocks. So consider slapping a like, and let's just
that there is a bubble in a lot of tech stocks that are very hard to try to value. I mean, I had CrowdStrike on last night. How do you value CrowdStrike? They have the highest annual recurring revenue of any company I follow. How do you value Zoom, which has changed the world over a period of 6 months? And I think the answer is it's incredibly hard to value. Does that mean you then default to owning FedEx? Does that mean you end up buying Tiffany after the deal broke down? Perhaps. I'm just saying, you know what, if you took something off, which is what we were advising, and I've been advising, I don't know if you still want to take stuff off. I've been recommending selling for 3 weeks. Now we have big-time people who come on air and say, you know what, maybe you should get out. I can't do that because I did. I was bearish. Can I be as bearish on a Zoom down 30%? Perhaps I should be. But in the end, the way I look at things is, if you haven't bought anything, maybe you dip your toe in, not when it's up a lot. I mean, do I want people to buy Apple up 3.5? Well, you know, maybe you buy little and let it come in. I get discouraged when I hear people who have never let us in, so to speak, who think that the great unwashed who watch the show are really going to hurt themselves. Well, they got hurt on Sorrento and on Vaxart. They made a mistake if they bought Tesla at the top. But you know what? Let's allow people to try to make some money.
Welcome back. Passive income investors alike. So if you're stuck listening to this garbage every day, chances are you are losing your mind. And what I would like to do is Sherpa you through these tumultuous times by offering you a perspective for new investors, along with people that have been in the markets for a little while here, folks. And then I'll shed my own opinion on obviously what I've been doing if you're new to this channel. But let's just start talking about valuation metrics here first. Now, many of us, every investor out there, I'm pretty sure, has been advising to stay away from Tesla. And there was just so many people buying the tops, following in this fear of FOMO, because again, Tesla's done nothing but run up for the last 6 months. And when that happens, like, you can't help but feel like an idiot. And at some point have to pull the plug and buy in until you see what just happens here, which was followed by a 30% correction. But the big problem is that 30% correction doesn't really equate to going all the way back much farther than July. Because, I mean, if you bought in July, you're technically still up on your Tesla position. So how do you comprehend this? Well, the first thing is that this is where all your focus is in your portfolio. You're already doing something wrong, because it clearly means you are simply under diversified. And if you are buying individual stocks like this and you've done any homework whatsoever, I'm sure you are getting the sense that Tesla was basically on its way to burning out, considering, you know, the S&P 500 didn't list them. They got deproved, not saying it can't happen in the future, but for right now, they're not getting that S&P 500 listing. Pretty bad news. And all the major Tesla channels like Hyperchange out here have been posting videos about how they've been taking profits to basically buy a Tesla vehicle. But these people have been investing in Tesla stock for quite some time, like myself. I've been in it for longer than a year. Which leads us to the question today, is Tesla a buy if you don't already own it? Well, I'm going to come back to that in a second, but let's go over a few other companies here real quick. Let's talk about Shopify, perhaps, which has run up 136% year to date, sitting at a $150 billion market cap. It is now the largest company in Canada, but is it justified? That's the question. If we go down into their basic valuation here and we look at their assets versus liability, just on Yahoo Finance, in their financials, guys, we can see they have a total asset of about $3.4 billion, minusing the $300 million in liabilities. This is really well capitalized. I mean, we're talking about $2 billion in underlying assets. The earnings absolutely phenomenal here. We're seeing a massive growth. They had revenues of $714 million and bottom line earnings of $36 million in Q2 of 2020, as we see the expansion in these online e-commerce businesses due to the pandemic. But when you look at the valuation Shopify has at $150 billion, and we compare it to the next largest company in Canada, being the Royal Bank, which currently sits at $138 billion, with a price to earnings of 12.5 and a dividend yield of 4.42. Let's compare the bottom line financials here. So if we take a look at the total assets they currently sit on, which is $1.42 trillion, minusing the liabilities of $1.34 trillion, they're sitting relatively close to 80 to 100 billion in underlying assets. And if we scroll down and just take a quick peek at their bottom line earnings for like the last quarter, they did $12.24 billion and they had earnings of $3.2 billion. Now let me just again go back to Shopify with an earnings of $36 million. What you'll start realizing is that a lot of these high-flying tech companies, when we're talking about Zoom, when we're talking about Shopify, when we're talking about Tesla, have literally priced in the large chunk of the next 5, if not 10 years of their earnings cycle, which is a scream of an overvaluation and that you should probably be avoiding these like the plague. But now, again, before I give you an opinion to new investors, what I'm doing and my personal humble opinion here, folks, let's talk about some other companies that sit somewhere in the mid-class where we are way more confused, especially when we're talking about things like Apple. Considering how confused Jim Cramer was when he's saying, oh, well, maybe you should pick up a little bit, but I don't know. Like, nobody really knows, considering Apple's sitting at a PE of 35 right now. We got Facebook sitting at a PE of 34. Microsoft, a PE of 37. And with people out there like Mark Cuban calling these stocks a bubble, I don't think it is an accurate opinion here, folks. When we're talking about these specific tech companies, the ones that make up the large weighting of the S&P 500, the top 10, for a matter of fact, there's literally two sides to it. Considering these companies are still having explosive revenue growth, and I mean, we're talking about, you know, tens of billions and hundreds of billions of dollars here. Without these current companies' conditions and products, I mean, trading at a 35 multiple would signify that these companies are still growth companies. And those would be the simple valuation metrics that society is willing to put on them. Now, it is going to take a little bit of time if you're buying them today to grow into these valuations. But are these completely absurd? In my opinion, they were about to get there when Apple was crossing into the 40 PE. But let me give you a quick example. I said this in the past, that the last time Apple was trading at a PE of 40 was when the first iPhone was released. And that was back in 2007, 2008, before they started driving any real revenue. But now we're talking about a company that is now growing over a 10% clip on tens and tens and tens of billions of dollars, folks. And you got to imagine, if you're collecting tens of billions, it gives you a lot of opportunity to do share buybacks, buy into more acquisitions, generating more cash flow. I mean, there's so many positive and negative things I could talk about these valuations, which is why when you listen to CNBC, they're so utterly confused. So what should you be doing? Absolutely nothing, folks, because here at the Passive Income Investor channel, we just sit back, we collect paychecks and let everything ride. Not really. Obviously, I have been taking profits. I skimmed some Apple profits. I skimmed Tesla profits. Those were actually the only two stocks I really skimmed profits of, in which I am still holding long. Now, it is not like I skimmed the entire position here, folks. I just had to bring them back down to a reasonable scale. But let's talk about this from a few different perspectives. And why I adhere so much to the passive income investing style is purely because if you are buying individual stocks, and if you can't sleep at night because of what is currently going on here, it means you are simply too involved in your stock portfolio. And if you're somebody that's in my situation where you have a decent build-up position in these stocks, there is nothing wrong with even taking a little bit of profit. Just presuming they have become overweighted in your entire portfolio, because leverage is your best friend and your worst enemy. Because if you were just holding Tesla stock and it ran up 400 or 500%, and you'd be in my position where you'd be looking at a $40,000 position, guys. That just doesn't make sense. My portfolio is just under 200,000. I don't want, you know, Tesla being 25% of my portfolio. It's just too risky, especially when we just watched the stock drop 30%. That is why I've been skimming profits all the way up, and that is just something that is logical to do. But because I am backed up by these massive blue chip companies, I don't got to worry about it because I have dividends coming in. And it's a lot less stressful because a lot of companies I hold, like the Canadian banks, I think are severely undervalued. But as I told you guys, let's say you're new to investing, you have no exposure to these, and you have no idea what to do because you're too busy listening to CNBC. Well, I don't think there is anything wrong with buying an Apple stock here, with buying something like a Microsoft. But if you're just getting into the markets and all your attention right now is on Tesla, you are doing something severely wrong here, folks, because the idea is a well-diversified portfolio. Yeah, a 3% yielding company like Johnson & Johnson isn't going to be that appealing against something like a Tesla or a Zoom stock. But the problem is you can't sit down and logically tell me how to value Zoom, how to logically value Shopify. But I can purely tell you, based on their current numbers, they have priced in a large chunk of the future when you could just buy something like a Royal Bank that's yielding a 4% already. And that is what you're going to want to do. If you're brand new to investing, guys, you do not want to be buying stocks everybody and their grandmother, including your Uber driver, is talking about. We know that is stupid. We saw it with Bitcoin. We saw it with the MJ market, and we're seeing it again now with these tech stocks. And yeah, we could see a bigger pullback in Apple or Microsoft, but that shouldn't stop you from buying it if you have zero exposure. And because I believe in a cost average investing strategy, if you buy Apple today on this dip, which is a beautiful dip, in my opinion, to pick it up on, yeah, you're paying a 35 times multiple, but we're talking about one of the greatest companies on the planet. And if something like a Tesla can be valued to the moon and back, and something like Zoom and Shopify can be valued to the moon and back, is it really that absurd to see a 35 PE on Apple? Now, if we were heading into the 40 to 50 range, I'd be a little discouraged because that would be heading into bubble territory, which also means that if you're buying into it today, don't expect the rate of return that we have seen this year or in prior years. If anything, you're going to see a pullback in capital growth until the earnings can catch up to these PE multiples. So don't be excited to think these things are going to do another 100% moonshoot. It's very unlikely, but I still advocate that you have this exposure in your portfolio because they're just staples to the economy. And if your time horizon is the next 10 to 15 years out, who cares what's going on today, folks? I mean, let's go all the way back on the S&P 500 here. If you basically put all of your money in the stock market back at the beginning of this year and you just turned the news off, walked away from your laptop, went and sat on the beach, literally up till this moment, and you came back, you'd be like, well, not much has changed. In fact, if I bought the S&P 500 index, I would still be up 5% year to date. Just don't get caught up in all the BS and this volatility that we are currently experiencing, because volatility literally leads to insanity for people. I mean, I just watched my portfolio in this little correction drop about $10,000 to $20,000. And of course, it's rebounding a bit today, but I am able to handle those fluctuations because I've attuned myself to it over the last 5 or 6 years. And if you're new to investing and you buy Apple and you bought it at the top of the market to just watch it sell off, and now you're freaking out thinking you should sell the position, these aren't the kind of investments you should be making. I mean, we can even talk about SPAC stocks real quick if you want to, because the SPAC stocks are exploding to levels that are just crazy, considering none of those companies really make any money, and those are going to be your risky speculative plays. I don't want you to think Apple or Microsoft is a risky or speculative play. Tesla, Shopify, Zoom, even though they do have really good, stable businesses, the reality is the valuations have made them speculative because they're no longer trading on underlying. They're just not trading on underlying fundamentals. So some key takeaways from this video that I want you guys to get out of this: turn CNBC off, get a nice diversified portfolio, adjust your risk exposure to a level that makes sense, because usually the rule of thumb is no more than 5% in any individual investment, though I think if you're in your 20s or a little younger, you could probably dip into about 10%. I mean, my max positions, I think, are around 10 to 12. But in my position, being in my 20s, you know, having a couple $100,000 invested, if I were to watch Tesla go to zero today or even drop 50%, and let's say I lose $6,000 to $10,000, is that really going to ruin my life? Absolutely not. But if your entire net worth and 50% of that is in Tesla and it went down 50% and it might not recover for the next 5 to 10 years until they can build up that earnings that has been priced in, I mean, you're not going to be comfortable with that. So why take on those kind of assumed risks? You got to imagine being like a pilot. I say this a lot. You want to prepare yourself for the worst case scenario. And luckily, when you own things like Pepsi and Johnson & Johnson, your portfolio is probably not doing this. So at the end of the day, if you feel like you're on a roller coaster ride and your portfolio is doing mood swings you're just not comfortable with, and it's making you emotionally get involved in your decisions, you're doing something wrong here, folks. So take a breath. Always think about the passive income investing style. It's just what works, and it is what is making me rich. I haven't sold out of my Tesla. I haven't sold out of my entire Apple. Yes, I trim profits, and it's only intelligent to do so if you are buying individual stocks and you're seeing these 400 to 500% returns. But don't think because your Uber driver, your mother, your grandmother are talking about you have to own Tesla stock. That's usually the biggest red flag. And don't get caught up in the nonsense, folks. Just get caught up on accumulating shares in really great companies. So stay cool, stay awesome, and I look forward to catching you guys tomorrow.